What would you do if you found out you couldn't sell your own car without handing the dealer $5,000 in cash first? On a modern 84-month car loan, that's not a nightmare. It's the math. You can owe more than your vehicle is worth for 4 to 5 straight years, and the reason is buried in a loan term almost nobody questions. I read the fine print so you don't have to. Millions of Canadians have signed 7-year car loans, and the combined cost is staggering. Thousands in extra interest plus a forced cash payout if you ever want out. Today I'll show you 3 moves. Check your real equity position, compare against a shorter term, and avoid trading in while underwater. The central number is 84 months, a car loan that runs a full 7 years. Canadian loans can stretch that long, and FCAC warns borrowers to choose the shortest term they can afford, because longer terms raise the risk of negative equity, FCAC 2025. But here's the part nobody tells you, that long term is exactly what keeps you underwater. 3 moves to get off the hook. First, check your equity. Second, compare against a shorter term. Third, refuse to trade in while underwater. Here's the first money leak. Depreciation outruns your principal. Your car loses value fast the moment you drive it off the lot, while the loan balance falls painfully slowly. That gap is what puts you upside down, what FCAC calls negative equity, where you owe more than the vehicle is worth, FCAC 2025. On a 7-year loan, a borrower can owe more than the car is worth for 4 to 5 years, according to Maple Tools, Canada's calculator, Maple Tools 2025. FCAC's better approach is blunt. Choose the shortest term you can afford and avoid trading in while you're in negative equity, FCAC 2025. The longer the term, the longer you stay trapped. The second layer is interest compounding over all those extra years. Stretching from a standard term to 84 months lowers your monthly payment but stacks up far more total interest, and it slows how fast you build any equity at all, Maple Tools 2025. That lower payment is partly an illusion. A 7-year term can cost $3,840 more in interest than a 48-month loan. Maple Tools Canada 2025. And with the average new car loan rate sitting at 6.5% as of October 2025, carrying that balance for extra years costs real money even before depreciation. WOWA 2025. You pay more for the car and stay stuck in it longer. The myth is that a lower monthly payment means the loan is affordable. The fact is a longer term can shrink the payment while increasing your total interest and keeping you underwater for years, which is exactly why FCAC recommends the shortest term you can afford, FCSC 2025. Put the 2 costs side by side. $3,840 in extra interest, Maple Tools 2025, plus a $5,000 negative equity gap to exit early, Go Auto 2025. Combined, that's about $8,840 of exposure from one 7-year loan. Meet Jason, 34, a warehouse supervisor in Ontario earning $68,000 a year. He bought a $41,000 SUV with $2,000 down on a 7-year loan, and in about 3 years he wants to upgrade for a growing family. Here's what Jason found. Discovery 1, 4 to 5 years. That's how long Jason could owe more than the SUV is actually worth on his 7-year loan, according to Maple Tools Canada, Maple Tools 2025. That's the whole window he wants to upgrade in, Gasperten Kwartier ter Samwangwarn, and FCAC's advice to keep the term short would have avoided most of it, FCAC 2025. Discovery 2, $3,840. That's the extra interest Jason pays by stretching to 7 years instead of a 48-month term, according to Maple Tools Canada's calculator, Maple Tools 2025. The comfortable monthly payment quietly cost him nearly $4,000. Discovery 3 is the one that stings. If Jason's SUV is worth $15,000 but his loan balance is $20,000, that's $5,000 in negative equity he'd have to pay out of pocket just to sell it. Go Auto 2025. And FCSC specifically warns against trading in while underwater, FCSC 2025. Added up and Jason's total exposure is about $8,840. The extra interest plus that negative equity exit bill, Maple Tools 2025, Go Auto 2025. That's the real price of the 7-year loan, and it's a number the dealer never put on the paperwork. Could this be you? You chose your loan by the monthly payment instead of the total cost. You don't actually know your payoff amount or your car's current value. Or you signed a term of 72, 84, or even 96 months. If any of those ring true, the next 3 moves are for you. So here's how you take back control, because knowing you're underwater is useless unless you act on it. These 3 moves cost nothing and take under 20 minutes each. They tell you exactly where you stand and stop you from making the trap worse. Move 1. Check your term and your real equity position. Call your lender and ask for the exact payout quote, the number to close the loan today. Then look up your vehicle's current trade-in value. FCAC's financing resources walk through the risks so you know what you're looking at. 3 steps. Ask your lender for the exact payout amount. Get your car's current trade-in value. Subtract the value from the payoff to find your equity. Good looks like positive equity, or at least a term short enough that you're not underwater for years. Move 2. Compare your current term against the shortest one you can actually afford. Note your monthly payment and remaining term, then recalculate the same vehicle price over a shorter period and watch what happens to the total interest and how fast you build equity. 3 steps. Note your current payment and remaining term. Recalculate a shorter term at the same price. Compare the total interest and the equity building speed. Good looks like a term materially shorter than 84 months in line with FCAC's advice. FCS 2025. Before I get to the last move, which is the most counterintuitive part of all this because it's the one dealers actively push you toward, this is where most people lose thousands. Move 3. Do not trade in while you're underwater, no matter how good the new deal looks. 3 steps. Request a payoff quote from your lender. Get a current trade-in estimate. And refuse to roll negative equity into a new loan unless you fully understand the cost. Good looks like no negative equity when you sell or trade. FCAC 2025. If breakdowns like this are useful, subscribe. The next one's already coming. Why act now? In 2025, FCAC's guidance is still current, still warning on negative equity and trade-ins. FCAC 2025. Also in 2025, reporting based on Statistics Canada data put the average new car loan rate at 6.5% as of October, WOWA 2025. And into 2026, lenders still openly offer 84 and even 96-month terms. Rate Hub 2026. The trap is live right now. After you act, here's how to verify. You should see your payoff amount sitting below your car's market value. Confirm any new term you consider is well under 84 months. And if a dealer offers to roll your old balance into a new loan, walk away until you've priced exactly what that costs. Everything here is drawn from FCAC, Maple Tools Canada, WOWA's rate reporting, and Go Auto's negative equity guide. The full links are in the description so you can check every number yourself. You now know how the 84-month loan leaves Canadians underwater and the 3 moves to escape it. Next, I'm covering whether leasing is actually cheaper or just a different dealer trap dressed up as freedom. That leasing breakdown will save a lot of people from a very expensive assumption. If you want to catch it, subscribe now so you don't miss it.